Hello, and welcome to our week ahead. And what a week it is coming up. We've got three major central banks in action: the Fed, the Bank of England, and the European Central Bank, all expected to raise interest rates. And we've got a whopper on earnings season as well, with Apple, Amazon, Alphabet, and Meta all due to report amid a very busy week on Wall Street for earnings. So first up, the Fed. All eyes on the Fed. All eyes on what it's going to do next. Consensus seems to be coalescing around a 25 basis point hike, so slowing down and then signalling maybe even a pause. So that seems to be the market consensus. It's this sense that disinflationary trends are starting to take hold, that inflation is coming down, that we've peaked on inflation. That narrative has fed through to decent performance for risk assets so far this year. The Nasdaq up around 10% for January thus far. Other stock market indices in Europe and the US up around anywhere from 5 to 8% as well. So we've seen decent performance for risk. We've seen the dollar fade. We've seen US yields moving to the downside. And really all that is saying is that inflation has peaked and the Fed is going to be slowing down. But that's not what the Fed has been saying. So we look to see what sort of messaging the Fed delivers on Wednesday night when that press conference takes place after the decision is announced. That press conference with Jay Powell will be critical, and we'll get an idea on where the Fed is thinking, what they're leaning towards, if they are leaning towards pausing their rate tightening cycle. That's the message that we got from the Bank of Canada last week, and so we wait to see if it's a similar sort of story in the US. Bank of England is expected to raise interest rates by 50 basis points. Inflation is not coming down anywhere near fast enough, but we think that lower gas prices and a repricing in money markets in terms of the terminal rate versus where we were looking at in September after the mini budget, if you recall, markets moved aggressively to price in a lot more hikes. Because the market has priced in fewer hikes, that potentially allows the Bank of England to raise its growth forecast. So we think probably 50 basis points, but it's what they do next. Is that the end of the cycle? Do they have more up their sleeve? What sort of messaging is there for the March meeting? Consensus is hovering around maybe another 25 basis points in March before the tightening cycle comes to an end. So really the message here is central banks getting to the point of that terminal rate, and the question mark will be, and the question for traders and for risk assets over the next couple of months is that the case? Have they peaked? Or is the pause merely a sort of short-term one, and then they need to hike a little bit more? So we wait to see what they say on that. European Central Bank, again, 50 basis points seems to be the consensus. But again, what's the message going forward? Christine Lagarde sounded pretty hawkish in December. She was signalling at least 100 basis points of hikes were due in February, March. Since then, the messaging from the European Central Bank has been somewhat more mixed, so we need to see what sort of message she delivers and what the statement from the European Central Bank, from the Governing Council, actually says. So we'll be keeping a close eye on that one. And then earnings season, as I say, you've got big tech reporting this week. You've also got non-farm payrolls coming up, but that's after the Fed meeting, so less important perhaps. The numbers so far, we've seen obviously very tight labour market in the US, but wages the last print wage numbers were a bit softer, and that sort of helped with the risk sentiment kind of story. And so we need to see if wages are rising. If you do see more pressure on wages, then it just signals to me that the Fed is not going to be stopping raising rates, and this idea of it pausing and pivoting is for the birds. And that's it for now. Thanks for watching.